Good day, fellow investors.
We discussed Kering, and there are always comments about L'Oreal, so hammered on slowing China revenues, LVMH going down. Is it a good opportunity to jump into beauty? Estee Lauder also, when China rebounds, looks like an easy 3 to 5x. Any thoughts? And let's really dig into the companies. L'Oreal, that is down a little bit, but if you look at the long-term chart, that has boomed. Louis Vuitton down 27%, long-term chart boomed over the last 10 years. And Estee Lauder, long-term chart boom and bust. So now we have to see whether this will bust like this, or this can rebound 3 to 5x as people say. I want to take this opportunity also to put this video into a story of free stocks perspective, discuss the beauty, the market, the great tailwind of growth there, the cycle, and then what is behind investing from a value investing perspective. Let's immediately start with L'Oreal. Their last press release, they are growing a little bit faster than the market, 5-6%, they grow 7%. All channels, online, offline, they have famous celebrities doing their marketing, of course. And if we look at the situation, the beauty market continues to grow, and they expect to have 100 billion bigger in the next 5-6 years. And that is great, and it's always great to invest with a tailwind. Now, as I said, that is the first thing to understand, and Warren Buffett says that even if you make a mistake, the tailwind, the secular growth trend can save you. From that perspective, if we look at the companies, you see, if the market is growing, it's much easier to do business in a growing market than in a declining market. And therefore, all numbers with L'Oreal are positive. It is much more diversified company than Kering that we just discussed with luxury brands. They have strong dividends that lead into negative residual cash flows, so that might be an issue. But if you look at the company, it's all good there, stable growth over time, boomed here, but it should continue doing well, nothing wrong there. It is still growing, it has boomed, especially after the pandemic, so that might likely slow down a little bit, but nothing wrong with the business, nothing wrong with the trend. However, just a thing of valuation, just too expensive, too risky, 2% free cash flow. If I compare to the market cap of what the dividend is paid, the rest is used for investments, etc. Nothing wrong, too expensive. If we put it on our quadrant, I would put it here because it's simply too expensive and too risky. And yes, the stock is down, but it's still far from any kind of value investing. LVMH, it is again down 27% from the peak. And now let's see what's going on. Rafa and Roger are there in the mountains, not playing tennis anymore. Sometimes, and this is normal with such brands, with the cycle, you cannot grow forever. They are diversified, even Sephora, we have discussed Ulta a while ago, and with the diversification, you see this nice and growing trend. Also, the net income is nice and growing, nothing wrong, but the stock is down. However, the P ratio is still 22 and the dividend yield is just 2%. So everything that's left there for the money not used for the dividend is used for the growth or for keeping the business there. So that's something that has to be understood, and these brands need to constantly do mergers, acquisitions, renovate, exchange the old for the new. So it's not that easy to just follow that beauty, fashion, luxury trend. They need to constantly spend money. So that's also something you need to understand before investing. And yes, the P ratio is lower than L'Oreal, so I have put it here in the box of others, Pernod Ricard, Nestle. This is, let's say, the market currently pricing at things at P ratio of around 20, which for value investors, even if those are good businesses, the risk is a little bit too high from that perspective of valuation, from that outlook, competitiveness, and also the reward is too low at dividends of 2-3% with some growth. Now, Estee Lauder, the stock went to almost 400, from 50 to 400, and now it's back to 88. And here we come to stock prices. We discuss valuation, value investing versus I don't care investing, which is what pension funds do, and you'll see that, and then a crash after insanity, but it's still just an okay investment. Earnings are down just on small decreases in sales. There have been some goodwill impairments, etc., etc. So okay, that can be adjusted, but still, if we look at the outlook there, they hope to revert things, to go back to historical mid-single digit growth that they have had thanks to China, that things stabilize there. But for now, earnings of $2.5–3, and we are still at a P/E ratio of 25 to 30, and that is still expensive. The dividend yield is there, 3%, okay, the highest till now, but still, if I look at things, if I look at what the average earnings were there, so there was this exuberant year, but then on average they make $3–4, let's say $4 when things revert to the mean of the cycle, and that's still a P ratio of above 20. Again, priced like all the other companies that we have mentioned here. And that leads to the discussion of value investing, and all these companies have huge market capitalization, 300 billion for LVMH, 193 billion for L'Oreal, 31 for Estee Lauder, and pension funds simply don't care. They need to invest based on market cap, index funds and ETFs, and that is an investing that we don't do here. We do value investing, and despite the stocks being down, those stocks are still just okay when you put this into perspective, and we will keep on striving to find stocks that go into this quadrant, which is low risk and higher reward. Thanks for watching. I'll see you in the next video.